Hello and welcome to today's episode of Focus On. I'm Nastasia Aransa. The total investable wealth currently held on the African continent amounts to $2.5 trillion, and its millionaire population is set to rise by 65% over the next 10 years. That's according to the 2024 Africa Wealth Report. Today we're looking at the possible ramifications of the US election on African markets and economies and what you can do to protect your wealth. For more on this, I'm joined by Adam Fayed, who is the founder of Adam Fayed Brokers. Adam, thank you so much for your time. Let's start off with the US elections. It was the talking point for pretty much most of the week and probably weeks in the lead up to that election date. Take me through your reaction when it comes to that outcome and the impact it had on the markets.
Well, when it comes to the markets have had a very good reaction, just as they did last time and the time before. The markets do like the certainty that this election has brought. Markets do tend to do well in the US after an election. But what was very interesting is a lot of bank stocks and other stocks in highly regulated areas skyrocketed after Trump's victory because people might disagree with many aspects of his agenda, but I think the deregulation agenda is certainly something that could be very good for US markets, or certainly certain sectors like the financial sector. What is a bit more uncertain, of course, is his plans for tariffs, because if Trump does bring in these tariffs or partially brings in these tariffs, that could actually increase inflation, which therefore means interest rates won't go down as much as expected. And also many emerging markets, whether it's in Asia or Africa or beyond, are highly dependent on international trade. So when it comes to these kind of tariffs, a lot of emerging markets could be a bit vulnerable to them. So that's going to be the big question as well going forward in the next year or two.
So let's build on some of those themes that you just spoke about, especially as it relates to the banks. I mean, the need for financial deregulation in the US, and in order for it to stimulate growth, are there risks? How are you looking at that conversation, especially given the rally that we saw with the banks?
Well, there's always risks, but often it's overplayed, because what you've got to remember is if you just look in the last, say, 5 or 10 years, how many regulations have been revoked in the US or any country versus new regulations, you can see a huge mismatch. There's thousands of new regulations and very few are revoked. And it's pretty fair to say that the SEC and pretty much all these major regulatory bodies are staffed to the hilt. But they were staffed to the hilt during 2008, and that didn't stop the financial crisis happening. And I think there's always risks of anything, but what could be interesting is to see if some of these regulations are loosened, what effect it might have on the banks and other financial sectors going forward. I think also what's quite interesting, of course, is that when Elon Musk came into Twitter, he got rid of 90% of staff, and people said that the website would be down and it would be chaos. And of course, that didn't happen. And that resulted in many people thinking that Musk should, be part of the Trump administration's kind of cost-cutting agenda in certain agencies. Obviously, we'll have to wait and see if it's a success or not. But I highly suspect that a lot of these agencies could be cut dramatically, and actually the safety of the consumer wouldn't actually be affected at all.
When you speak of emerging markets, one can't help but bring up the topic of China. Does the election outcome and the market reaction to that sort of force the hand of Beijing to unleash full quantitative easing?
Yeah, quite possibly, because the economy is already weak in China, probably more than the official stats actually show. And many economists have also brought up that point. And then the last thing they need is also a trade war, partial trade war with the US. So it looks like China might be forced to stimulate a little bit more, because the external environment is actually very weak for them right now. With that being said, though, you never know what could happen. It could just be the case that the Chinese have a deal with the Americans where they say, well, look, we'll build factories in the US to get rid of these tariffs, and there's some kind of negotiated solution. So we'll have to wait and see. But obviously, in general, this isn't good news for China, what's happening. But having said that, it's now a bipartisan consensus pretty much in the US where the US has become more protectionist, and that would have continued under Harris. Of course, Trump's tariffs are much more extreme if he brings them in, and that would definitely be a major risk for China. But as I think we discussed last time when I was on this program, at the end of the day, the economy and the stock market aren't always linked. So actually, if China's economy is weak, it could be good for their stock market potentially, because they might have to do quantitative easing and stimulation of the economy and so on and so forth, lower interest rates. And that could actually be good for asset prices. So we've seen now recently in the last 6 months, the Hong Kong stock market has been pretty much the best performing developed stock market in the world, even though the economy is pretty weak.
Over the past couple of days since we've gotten that election result, what are some of your clients asking you?
Well, I mean, some of the clients, of course, are a little bit concerned whenever there's any change, and people in general are easily concerned by these things. I think people are less concerned, though, compared to 8 years ago, because 8 years ago, when Trump came into power, a lot of people were panicking about what the ramifications of that could be. But of course, the ramifications weren't negative on the stock market. At the end of the day, stock markets and assets in general tend to go in a fairly favorable direction long term, no matter who's the president. It went up during Biden's time, Trump's time, Bill Clinton's time, and so on, Obama's time. So I think this time people are less worried. Having said that, I think they are worried about emerging markets, as you said, China as well, and also the sectors as well. So the perception very much amongst many people, probably quite rightly, is the financial sector, the energy sector. Also, in addition to that, defense stocks could actually be something that could actually be a good play here. So I think people aren't pressing the panic button, so to speak, but they are definitely curious about what kind of sectors and countries could be winners and losers from this.
The one thing I found quite interesting is that we're starting to see a lot of these Trump trades beginning to unwind a touch. I mean, if you look at them in a couple of places, notably the US dollar has come off a bit, and especially post the Fed and the comments that came out of that. I mean, if you had to think, what was the most unusual aspects, or perhaps even aspects around the Trump trade that didn't make sense to you?
One thing that was interesting was small cap US companies really skyrocketed after what happened with the election. And I can understand the trade from the point of view that ultimately, if the US is going to become a bit more protectionist, which has been the general trend now for 10 or 20 years, arguably, that's going to be good for the domestic economy, potentially in the US, and less good for exporters. But ultimately, though, by the same token, if you've got a situation where the US is actually putting in tariffs and other measures, some actual small companies might suffer from that as well. It's a two-way trade, because if you've got a relatively small company that's manufacturing and importing and exporting from China and beyond, it's not automatically the case, of course, that they're going to benefit from this. So I think that was one of the things that was, potentially a little bit surprising. And also some of the things were quite speculative as well, like, for example, the moves in crypto and so on.
Let's move and look at things in the UK, where we're seeing millionaires that are leaving the United Kingdom. What are some of the reasons for that?
Yeah, it's quite interesting, because looking at the stats now, and just from our own experience dealing with clients around the world, the UK and Canada in particular, we've seen a lot of wealthy people leave these two countries recently. Now, there's many reasons for that. But I think one of the biggest reasons isn't just tax. It's really the sense that taxes are rising and the services aren't getting better because of the aging population. And there's a general malaise in terms of low growth, high regulation, high taxes, and there isn't light at the end of the tunnel. And I think a lot of people are motivated beyond tax to move to places maybe that are a little bit less regulated, have a bit more personal freedom. And I think we saw something similar in Canada as well in 2022, after the truckers and so on and so forth. So I think it goes beyond that. But I think also it is becoming a much bigger thing now, because I heard a new expression. I mean, we've all heard of Brexit, right? But I heard of a Wexit, which is basically wealthy people leaving the UK. And it's become such a big thing now. So I think 28,000 millionaires have left in the last 5 years. So that's a huge amount when you consider that the UK has a population about 5.5 times smaller than the United States.
I'm curious, when they do leave, are there, areas or regions that they are relocating to or that they're finding attractive?
If you look at the biggest areas, places like Dubai or indeed even now Florida, but also places in Europe like Portugal, those places are the most popular, I think, right now with most British people. It does depend on their status. If they're a retiree, they're more likely to go to Europe. If they're a business person or entrepreneur, they're more likely to go to a place like Dubai. But essentially, most of them are going to those lower tax jurisdictions that are also on the move up. So the likes of Dubai, we have to remember that just like Mexico and just like some of these other countries, we spoke about the US and China earlier. We have to remember one of the big trends in the world now, as the billionaire Ray Dalio has said, is that as China and the US, their competition essentially heats up, those third countries like India, the UAE, maybe Mexico, who are quite open to money from all around the world, are actually benefiting from this situation. So after the Ukraine-Russia war, for example, Dubai got in not only British people, but Russians, Ukrainians, Chinese, people from all around the world. So what we're seeing right now is a lot of those third jurisdictions, like the UAE or for that matter, Singapore, where they're relatively neutral in terms of their political outlook as governments, they are actually benefiting quite a lot from the rise in geopolitical tensions.
Given everything we've discussed over the past few minutes or so, how are you then advising your clients in terms of how to invest, given everything that's happened over the past week?
Well, I think one trade that people have to be careful about is government bonds. So the TLT ETF, which is like the long-term government bond ETF, it's been getting in record inflows. And there is a logic associated to that because as interest rates come down, usually US Treasuries do very well. However, in this situation where you've got a situation where the UK government's spending more money, the US government's going to spend more money, global protectionism is going up, there is actually a risk that unexpectedly next year, interest rates could actually go up rather than come down. Now, everyone seems to think interest rates are going to go down. And I do think on the balance of probability, that's still the case. But the risk of an inflation spike in the next year or two is now much higher. So that means people have to be a bit more worried about US Treasuries. When it comes to emerging markets, they look very cheap, but they're cheap for a reason right now. And what's happening between the US, China, and these other things, tariffs and so on, could really affect emerging markets. That doesn't mean you shouldn't have an allocation to it. Maybe 10%, 20% is fine, but risks have definitely gone up for those emerging markets because they are highly dependent on global trade.
Adam, thank you so much for your time. That's how we wrap up this episode of Focus On with myself, Nastasia Arendse. Thank you to my guest, Adam Fayed, who is the founder of Adam Fayed Brokers. From me, it's a goodbye. Good day and welcome to today's episode of A Focus On. I am Fifi Peters. Today we are looking at the investment market and which options are the best bang for your buck, taking into consideration the current investment climate that we do find ourselves in. According to Schwab, 51% of new investors don't understand how investment fees actually work, and 41% haven't considered tax efficiency. To delve into this conversation a little further, we will be speaking to Adam Fayed, founder of Adam Fayed Brokers. Adam, thanks so much for your time. Let's just begin with a reflection on the environment that we find ourselves in right now. So globally, a lot is going on. On the one hand, you've got geopolitical risks that are mounting. On the other, we've got the continuation of the cost of living crisis and this environment of interest rates that are expected to remain higher for longer and the impact potentially on investment returns. What is your assessment of the global economy right now and where high net worth individuals, some of the individuals who you currently service, where they are investing?
Well, the environment is actually very risky at the moment in certain regards from the point of view of the economy, because obviously you've got higher interest rates, you've got commercial real estate that looks quite risky in many ways. So many things can go wrong for the economy. But we do have to remember that historically, geopolitical risks haven't had a huge impact on equity valuations. So, for example, during the Cuban Missile Crisis, even during World War I, and also the Spanish flu pandemic and the recent COVID pandemic, those geopolitical risks haven't always resulted in lower equity valuations. So the two things aren't always linked, even though sometimes they can be linked. When it comes to the current situation, I think with interest rates possibly peaking, a lot of people are looking at fixed income, where it is US Treasuries or those A-rated opportunities that have also been pushed up. So you have many A-rated firms paying 7% or more now. By the same token, you also see some people who are looking at non-US stocks, because in the last 10 to 15 years, the strong US dollar has really pushed up valuations of the S&P and the NASDAQ and the Dow Jones, whereas many markets such as the ASEAN market in Southeast Asia and Africa and so on haven't done very well when it comes to stocks. So we are starting to see other investors thinking, well, this could be peak US dollar or close to that. So they are looking to go to the emerging markets again, especially at very low valuations on a price to earnings ratio, and in many cases, high dividend yields as well.
But just sticking to the US market, because some of the most expensive or valued companies in the US right now are in the tech sector. And I imagine that the investors who are plowing into that sector, obviously investors who can afford to do so. But I'd just like your take on that spot as a geography to park money, and whether you think that there is still room to get more in returns at this stage.
Well, very long term, there's always a good chance that tech will outperform because, for example, from 2000 until 2020, the NASDAQ beat pretty much every index in the world, but it was completely stagnant from 2000 until about 2014 to 15. So very long term, tech has always been more volatile, but it has produced better returns. Having said that, technology is heavily reliant on interest rates. So we've seen kind of emerging tech with the kind of Cathie Wood's kind of fund really being hammered by higher interest rates. But big tech, whether it's Apple, Microsoft, and others, are in a very strong position, much stronger than big tech in 1999. So I think they could long-term benefit, but technology is inherently more risky, especially when you go to individual stocks. But very long-term, if somebody's just willing to, put their money to work for 30 years, I don't think anyone will necessarily regret just buying the NASDAQ as an index, for example. But individual tech firms did get ahead of themselves when it comes to the valuations, and the price to earnings ratios went crazy. And a lot of the projects that existed could have only existed in a 0% interest rate environment. And right now, even though interest rates are probably peaking, I don't see us going back to 0% rates anytime soon. And that will really hammer some of the smaller tech stocks and some of the tech stocks that maybe aren't profitable. But I do think long-term technology is probably primed to overperform. But anyone who goes into that space has to realize it's incredibly volatile. And we've seen that in the last 2 years, right? Last year, the NASDAQ was the worst performing major developed market index. This year has been pretty much one of the best performing. So we kind of see that as a long-term trend as well. So we are bullish on tech, but only when it comes to long-term trajectories, when it comes to those kind of big, solid tech firms, not the more speculative, non-profit generating firms.
Talking then about emerging markets and going back to a comment that you made earlier about the investment appeal in some geographies in the EM space. I mean, the EM space pretty big, and including China. China, who has headlined for most of this year, probably for the wrong reasons in terms of not delivering on the return and expectation of its economic performance that was initially penciled in at the start of the year. So if we just break down the investment opportunity in the EM basket then, which parts of EM are looking attractive to you right now?
Well, with China, you never really know because the data is not transparent and there's so many political aspects that could actually affect the valuations in the market. So we saw that with Alibaba and the huge crackdown on Chinese tech. So with China, you can have a good return, as happened from 2000 until 2006. There was also a huge increase in equity valuations in about 2014-15 now. But with China, we do see it as very high risk. That doesn't mean it won't overperform or outperform in the future. It could do, but the risks are very, very high. What we see is Southeast Asia could be an area that could benefit a lot because the price to earnings ratios are very good, the dividend yields are very good, and also as China has become more expensive, more firms are actually moving manufacturing to Mexico or Bangladesh or certain countries in Southeast Asia like Vietnam. And besides, when you've got a very strong US dollar, it only requires a little bit of weakness from here to actually push up equity valuations. So the MSCI ASEAN market, for example, has been pretty much flat for 10 years, but we only need to see a small change in currencies to really change that. I think some of the markets in Africa could be interesting as well, potentially. Although in that space, there are fewer funds and ETFs we like because of the way the indexes often work there, but we do think long-term Africa and the African markets could be a decent place for a certain percentage of a portfolio as well.
So like what then, if we break down the Africa basket, which countries or funds specifically, and when you talk about the fact that long-term Africa could be a good place to be putting a portion of your money, what would you reckon would be the correct allocation of money in this environment?
Well, there's a few ways of doing it. From the point of view, we have to remember to start with, you can get broad-based allocation also from the developed markets. So, for example, one of the many reasons the Chinese stock market hasn't done well, despite on paper the economic data looking good from China, is that many of the US big companies actually sell into China. So if you look out of your window in China, you'll probably see a Starbucks and maybe an Apple store and so on, and that's the same all around the world. So the first play could be you could just invest into companies or sectors in the developed world that are actually doing better in the African market. That is one way of doing it. And of course, as Africa probably improves as a continent, you will also see more African firms doing IPOs on the US stock market in the same way that Alibaba and many Chinese companies did the same. But if you want direct equity exposure, a lot of the markets are still in the early stages, and most of the people in those markets actually want to invest internationally, which often makes sense. But possibly the South Africas, the Mauritiuses, any place where potentially they're like hubs for the African region, I think they're more likely also to see companies from East Africa and West Africa actually get on the market, because very long term, the Nigerias of this world, maybe Ghana as well, some of the East African markets, Kenya, Uganda could also do very well. But obviously there's always huge geopolitical risks in most parts of Africa. So that means broad-based diversification could be important, and potentially any firm that's willing to actually IPO on foreign markets, it could be worth looking at those kind of firms as well, because often they're doing it for a reason. And also the transparency that brings, if they're willing to do an IPO on the US stock market, means that there's some reassurance for investors as well. So those are a few areas that people could look at as well. When it comes to percentages, it's always very difficult to know exactly how much people should invest into different areas. Obviously, a very low-risk investor maybe should consider whether to do it at all. But for most investors, if they're medium risk, possibly at this stage, 10 or 15% of their portfolio going into emerging markets, that's not a bad allocation, especially considering how cheap they are right now.
And which sectors then would be the places to be looking at a little bit more closely right now? Because, I mean, as I mentioned, the cost of living crisis, relatively high levels of inflation compared to historical levels, wages that are not keeping up with the price increases have cast a shadow on investing in consumer-related stocks for some, depending on which consumer you're talking about, because the US consumer has obviously shown themselves to be a lot more resilient. But then you've also got this move by countries all over the world to transition into lower carbon fuels against the backdrop of the just transition that's fueling all these investments into energy and renewable sources of power. So which sectors right now are looking attractive to you, and the sectors that perhaps have longevity to continue giving returns in the medium term?
Well, very long term, the e-commerce and technology spaces, I don't think won't be bad places at all in the African market. Because if you think about it, most of the population growth in Africa in the next few decades is going to be in Nigeria. And indeed, most of the population growth for the world is going to be in Africa. So any of those kind of mass market companies, equivalent to Amazon's, anything which is online, focusing on the mass market, the tech market, I think that will do very well long term, just from the point of view that the demographics look good, and that will actually really be a reason to actually invest in those mass market firms. More short term, maybe those companies that are actually focused on the bread and butter side of the consumer, in other words, those consumer staples. We all need toothpaste, or we need to eat, we need to fill up our cars. Those things tend to be quite recession proof, or even in a case where there's a cost of living crisis, we still have to buy those essential goods, right? So possibly short term, that will be a good play. But if we look very long term, we do have to remember the biggest reason to invest in companies is if there's a growth trajectory. And especially in Africa, there's a huge growth trajectory, I think, when any company is online or focused on the mass market. And whatever happens this year or next year for cost of living crisis, long term, that will be the biggest market, we think, in Africa.
All right, Adam, thanks so much for sharing that thesis for investments that you hold. That was Adam Fayed. He is the founder of Adam Fayed Brokers, just helping us wrap up this week's episode of Focus On. Thanks to yourselves as viewers for staying tuned throughout this very informative discussion. And until next time, it's goodbye.